Good afternoon, everyone, and thank you so much for joining us for this webinar giving an overview of the Impact Management Project. My name is Nicole Harmon. I'm a program manager with the Intentional Endowments Network, and I'm very pleased to have Brian Trelstad, a partner at Bridges Fund Management and part of the team that has been facilitating the Impact Management Project, with me here today to discuss this work. After Brian's presentation, we'll be spending the remainder of our time in dialogue responding to your questions, so please enter your questions throughout the presentation in the chat function of the control panel at any time, and we'll try to get to as many of them as possible. This webinar is being recorded and will be distributed to all registrants by email and will also be available on our website shortly after it's completed. So you can refer back to this conversation and share it with others. And we will also make the slides available upon request. So just briefly before we dive in, for those of you that aren't familiar with the Intentional Endowments Network, we're a nonprofit collaborative peer learning network with the goal of supporting endowments and enhancing performance by aligning investments with institutional mission, values, and sustainability goals. And we do this in a variety of ways, including hosting in-person forums and events, facilitating peer networking, curating useful resources on sustainable investing opportunities, and providing educational venues such as webinars like this one. So we encourage you to stay engaged in these conversations after today's webinar. More information on IEN is available on our website. You can see a link on this slide, or you are welcome to reach out to us at any time. So with that, I will turn it over to Brian.
Thanks, Nicole. And as Nicole said, I'm Brian Trelstad. I'm a partner at Bridges Fund Management, which is an impact investment fund with offices in both London and New York. And this work, the Impact Management Project, really derives from our experience as a practitioner making investments with measurable social or environmental impact and trying to understand how to communicate back to our investors whether or not we are achieving their impact goals for why they invested in the company and our fund to begin with. And to help ground it in reality, if you shift to the next slide, one of the first investments that we've made in the United States is in an after-school education company called Springboard Education. Springboard is a parent pay model that provides a credentialed teacher on school site to help kids in the hours from 3 to 6 p.m. For those of you that are parents of kids in the late elementary and early middle school years, that's a time where after school programming is not as structured and where kids unattended can find themselves getting into trouble. And so this is a model that has an academic enrichment program, again, on school sites, mostly charter and Title I schools, with a goal towards trying to close the educational achievement gap, making sure that kids who may not have a place to go that supervised have a supervised environment to do homework in that might then lead to their improved attendance and or school success. So the question that we ask ourselves when we're thinking about Springboard is, how do we know whether the students that are part of the program are doing better? And what is the demographic background of the students and their families such that we know that we're reaching the kind of underserved population that our investors invested in our fund to reach? And these are live questions that fund managers and companies are now wrestling with. And in my 15 plus years experience in impact investing, they're often fraught with misunderstanding and expectations around, well, what would a grant maker or a philanthropist do? What would a traditional commercial company do, commercial fund manager do? And what the Impact Management Project has tried to do, if you flip to the next slide, is really understand the various motivations and intentions along the capital chain from asset owner to fund manager to company, and to ultimately the people on the planet that we're benefiting, and see if there's, if you flip to the next slide, a golden thread that connects those asset owners who are looking for opportunities to help invest in closing the education achievement gap, or a particular SDG, into fund managers who make impact investments that are aligned with those goals, into companies that are relevant and are also mission driven to achieve the same goal. And ultimately, the experience of people on planet aligns with what the company, the fund manager, and the asset owner want to do. And right now, that communication chain of information is not well defined or understood, certainly not as well defined or understood as the financial flows of parents paying the company repaying our investment, and our fund repaying the investors who've invested in us. And what we're hoping to do with this project, the Impact Management Project, is really introduce the concept of moving from impact measurement to impact management. And if you go to the next slide, it helps frame out what we believe is an ongoing learning process up and down that capital chain, where it starts with defining the intentions and constraints. And we believe that there's a lot of capital that's been allocated to responsible, sustainable, or impact investing that has not really been clear as to what change it wants to seek in the world and what constraints bind it in terms of time frame or return expectations. Once those are clear as your financial objectives might be, you can then set pretty clear investment-specific financial and impact goals, whether that's for a fund or for a direct investment. And then ultimately, you can use those financial impact goals to measure and manage the experience of people and planet. And a lot of the impact investment energy has been on that top circle of really trying to measure what difference are we making, but to do so absent understanding the intentions and goals is hard to then ultimately deliver and improve the impact that we want to see. And so if you go to the next slide, the project that I'll walk you through over the next 20 or so minutes, and I know there are already a number of great questions that have come in, I want to leave plenty of time for questions, is really a field-wide effort by a number of leading impact investors that's been facilitated by Bridges Fund Management and a small advisory arm we have called Impact Plus, but funded by a combination of foundations and development finance institutions like the Omidyar Network, Ford Foundation, MacArthur Foundation, FB Heron, and the UK's Department for International Development, each of whom is committed to building out a robust ecosystem of impact investing, but also a large number of asset managers who are wrestling with how do they translate the goals of their clients into portfolios that help meet their impact and financial goals. And so this group of folks on this slide are the funders of the project. We've been at it for about 18 months. And the resulting analysis that we'll walk through over the next 6 or 8 slides is derived from consensus in the field. There have been about 1,000 practitioners, fund managers like a Leapfrog, asset owners, again, like UBS and Barclays, which have been wrestling with what are the shared fundamentals that we need in order to have that golden thread work, that flow of information around the impact that we want to see with the impact that is being experienced up and down the chain. And the starting point, if you flip to the next slide, of understanding impact is really to think about the 5 dimensions. And much like you can't really understand a physical object without understanding its 3 dimensions, we've from the consensus of peer practitioners from the Acumen funds, the Root Capitals, the Leapfrogs, the Generations, we've all agreed that to understand the impact of any investment, you need to really understand, first of all, that the impact happens between the enterprise and the people and planet that it is seeking to benefit, and that all enterprises have material effects, both positive and negative, unintended and intended. Most of the work really started with what is the intended positive impact that a springboard would like to have, and you can't answer that question without thinking about these 5 dimensions. The first is what outcome are you seeking to have? In the case of Springboard, it is educational achievement or closing the educational achievement gap or improved test scores for kids. A popular and well understood what today are the SDGs, which is a very useful framework for understanding what kind of change in the world an asset owner might want to see. But it really starts with what difference do you want to make, what outcome do you want to see, and then for whom. And the consensus in the field was not to talk about folks who are, quote unquote poor, but rather folks who are underserved with relation to the outcome. In the United States, for example, a diabetes investment might look to target folks who are underserved with respect to diabetes management, without regard to demographics, although there may be an overlap with demographics in that analysis. But really the first questions are what outcome you want to see for whom, and then how much. And there's a classic debate in the field about whether you want to reach folks at scale with a moderately important outcome, or whether you want to reach a handful of folks with an intensive outcome. So for example, if you thought about education achievement, again, an after-school program that reaches 5, 10, 15,000 students is not necessarily going to change their academic trajectory in the same way that perhaps a scholarship program or an intensive tutoring program for 100 students might. And so there's always a trade-off between the breadth, depth, and duration of an intervention. So those are the three things that help provide an understanding of what impact you're hoping to have. The fourth and fifth are really a little bit more nuanced, but the question is, what difference does the company make? What difference does Springboard make to the student populations that it is serving, that the marketplace of either nonprofits or the school itself would not otherwise make? And in the academic literature, this is a question of additionality. We've decided that trying to demonstrate through peer reviewable randomized control trials is not a threshold that an impact investment needs to make, but we should ask the thought experiment of what difference does this company make to this problem, to the population. And then finally, it's important to understand the risk that the intended outcome differs from our expectation, or that there are material unintended consequences that we might not have thought about that we need to be mindful of. So this is the sort of fundamentals, and when you begin to think about an enterprise, a company like Springboard or a solar panel manufacturer, if you flip to the next page, you can begin to tease out a sort of statement of effects, an analog to the financial statements, which look at all of the effects of the company on its material stakeholders along those 5 dimensions. And if you look and start to understand a business's effect, they typically cluster into 3 broad categories. There is obviously a 4th category, which is businesses that either don't care or are in fact having harm. But for those that are trying to make a difference, there are businesses that seek to avoid harm, that are trying to prevent significant effects for people and planet. There are then those that are benefiting people and planet through perhaps diverse workforce, gender equity, strong environmental practices, but may have a socially or environmentally neutral product. And ultimately, there are businesses that are seeking to contribute to solutions. And the ABC, for those of you who are familiar with kind of responsible, sustainable, and impact investing, map to those concepts without using those terms, which are laden and often misunderstood. But at the end of the day, a business based on the full effect of its impact can be categorized into one of these 3 broad buckets of avoid harm, benefit people and planet, and contribute to solutions. And Springboard, we would argue, is trying to contribute to a solution of closing the educational achievement gap in the United States, a job-creating business that makes ball bearings in an underserved, economically underserved part of the United States, might be benefiting people on the planet with good sort of blue-collar wage jobs in areas where they're lacking or have been on decline, and a business that is trying to cut its carbon emissions, but otherwise doesn't have a positive solution in its business model, might be simply avoiding harm. And so, again, empirically, that's where the landscape of businesses flows, and there's a lot of work that needs to be done. There are initiatives like B-Lab and the B-Assessment, which is trying to use a standardized set of questionnaires to see where businesses will fall out on this. But that's taking the 5 dimensions and thinking about how you put businesses' impact in buckets is the first step of understanding impact management. The next slide really introduces the idea that there's a role that investors can play as well. So if you flip to the next slide. In addition to impact happening between an enterprise and the people or planet it is seeking to benefit, investors do make a difference. There's also obviously a sort of default 5th category, or category 0 here, which is I don't really care. But members, presumably the Intentional Endowments Network, are thinking intentionally about their endowments, and all investors that are seeking to make a positive difference with their capital, we found through this process, can do so in one of 4 ways. The first is to simply signal that impact matters, either by choosing not to invest in or to favor certain types of investments, or to ask for information from those investments about, for example, carbon footprint. So a fair bit of responsible investment over the last 40 or 50 years has really been a signaling by asset owners that they care about certain issues. The second way is to engage more actively, whether that is as an activist shareholder to vote your proxies, or whether that's as a control investor in a company like Bridges, which owns a 65% share in Springboard. There are investors who are seeking to drive positive change through more active involvement. The third way is to identify gaps in the capital markets and to grow new or undersupplied capital markets. One might argue that the emergence of emerging markets private equity over the last 20 or 30 years is really a reflection of an observation that there's an undersupplied capital market and a real return and impact opportunity by investing in emerging markets. And then finally, there are folks who are in the impact investing space who can provide flexible capital. It might not be in the province of a university endowment to have more flexible capital, but certainly single-family offices like the Omidyar network are able to play across the returns spectrum and have invested often in below market or concessionary or higher risk opportunities, both funds and directs, that are not necessarily something that a purely fiduciarily managed fund can do. And so when you combine on the next slide, the enterprise contribution, one other step before we get to the combination, flip back to that next slide, sorry. Yeah, here it is. So those four things can actually happen in combination. So an investor might ask a set of questions that will lead them to whether or not they simply signal, the top green path is, somebody who wants to think about the capital markets and how they might change it, but I need to generate a competitive financial return. I do want to invest in well-established markets, and I'm a passive investor. Well, then you're a signal. Impact matters. But if you are willing to, grow new or undersupplied capital markets, you might be down at the bottom of this spectrum. But those four stances can be used in combination, and we've seen examples of fund managers that have different levels of investor contribution. And if you go to the next slide, this really takes the three impacts of businesses, the avoid harm, benefit stakeholders, and contribute to solutions, and combines them with investors' contribution to create what we're now calling the investors' impact matrix. And for those who've spent some time looking at and trying to find ways into the combination of responsible, sustainable, and impact investing, this framework has been a bit of an aha and a little bit of a Rosetta Stone to what is arguably a very confusing and at times not very clear field in the impact and sustainable investing field. But if you think about the kind of the poles of the framework, somebody who simply wants to avoid harm and signal that impact matters might invest in a screened bond fund or a screened indexed fund. Whereas somebody who is actively seeking to invest in, for example, economic opportunity in Rust Belt cities, but is doing so with a private equity fund model. Steve Case's recently launched Rise of the Rest might be in the sort of contribute to solutions and the fourth row, private equity fund that's making anchor investments in a community that's deeply underserved by capital and taking kind of control positions in those businesses. So you can begin to see that there is a landscape of opportunities that are mapped quite well to the theoretical understanding of what do the underlying businesses actually do, from avoiding harm to benefiting stakeholders to contributing to solutions, and what is the investor's stance towards them. And since we've developed this conceptual tool, we've had a number of asset owners use it to understand their holdings. And the next slide is an example of the pension fund in the Netherlands, PGGM, which has a 200+ billion euro pension fund, all of which is screened, at least for negative funds. And so they use this to ask where their different fund strategies fit. And no surprise that the bulk of their portfolio is still really in the avoid harm, and the bulk of that is still largely in the upper left, where they simply signal that impact matters. So they've invested in government bonds and listed real estate and private real estate opportunities where they're simply signaling that impact matters, but there's not a strong bias towards solutions in those strategies. But they do have roughly 2+ % of their total portfolio, which they would argue is trying to push the envelope in terms of what the enterprises are doing to solve mostly a focus on climate through their everything from more passive positions in some of the private equity funds to small positions where they have engaged more actively and grown new and undersupplied capital markets, for example, in an infrastructure fund that's focused on climate with about $1 billion allocation. So this is an example of a fairly traditional and fiduciary asset manager that has a very progressive stance on responsible investing, using this framework to understand what its holdings were. And one could imagine taking this map of their holdings back to the trustees to ask the question, is this achieving the goals that we set out to achieve? Presumably, again, in a perfect world, each of these holdings would have information about what kind of effects they're having for whom and how much, so that the trustees of the fund would be able to understand whether or not the fund itself or the overall portfolio and the individual funds and investments within it are helping to drive towards the goals that the investment committee set out when they wrote their investment policy. At the other end of the spectrum, on the next slide, is a small foundation, the KL Felicitas Foundation. For those who've been active in impact investing may know of Charlie and Lisa Kleisner. They are the co-founders of Tonic and the 100% Club, which is looking to align 100% of their endowment along mission lines. And they've used the framework for the same purposes, which is to understand where they are. And you can see, obviously, a much greater percentage of their portfolio, half, is in the contribute to solutions, and where they've been particularly active is in trying to grow new or undersupplied capital markets. They like to be, the first investor into a private equity fund that might not otherwise be able to get to that first close. They like to invest in creative alternatives and fund managers that are investing in creative ways in public equities. And so this is a slightly different fingerprint of a different fund manager who's also a foundation with a very small number of decision makers. But again, the Kleisners have found this to be a very helpful way for them to understand and have a conversation. Are we doing with our portfolio what we want to do from both a financial and an impact perspective? And so the last slide is really just sort of for those who are like the single page takeaway. This is a summary, and the 5 dimensions of impact are an important consensus that we've arrived at. We're trying to now embed in a lot of the other existing reporting initiatives, which were part of the development of the Impact Management Project. But for example, the B-Lab, B-Assessment, and the GRI, the Global Reporting Initiative, and the SASB, the Sustainable Accounting Standards Board, that these all align. But to truly understand impact, one needs to understand what an enterprise is doing along these 5 dimensions. Then the next step, and this is where there's a lot of work that the field still needs to do, is how do we agree on how can you easily, cost effectively take that information and roll it up into kind of a broad classification into an A or a B or a C. I think we're still at the point where we kind of know it when we see it, but there is hopefully more and more evidence and information about enterprise level performance, which will allow for, if not absolute, then simply comparative analysis of which businesses are doing more to solve which problems. But ultimately, the objective of having this frame at the enterprise level is to be able to answer the question of an investor: am I achieving with my portfolio what I sought out to achieve, whatever that is? And so the ABC and the 5 dimensions are really in service to this broader practice of impact management, which gets back to the investor's contribution. What goals do you have and what role do you want to play? And then using the investor's impact matrix to understand whether or not the combination of financial and social goals are being met through your portfolio. The last slide just sort of tees up what does this mean for you in your context, and assuming that of the 30 or so folks that are on the phone, most are either trustees or staff members of endowments that have been asked to consider or explore responsible or sustainable investing, or may already have a portfolio of it. I would just sort of say these are the 3 things that to me seem like clear next steps. One is to understand whether or not you and your trustees have a clear understanding of what your intentions and constraints are vis-a-vis responsible, sustainable, or impact investing. If you do understand what you're trying to achieve and what role students and faculty and staff and alumni play in setting those intentions and constraints, have you then translated those into an investment policy that allows you to set specific impact and financial hurdles that are consistent across the board? And then ultimately, what data are you asking for and collecting to evaluate whether or not your portfolio is helping to achieve your impact goals? I have no doubt that you have ample information to understand whether or not your portfolios are helping to achieve the financial goals, but what information can you ask of your fund managers and advisors, and in cases where you're making direct investments to help answer those impact questions? And so that's effectively what we had. We're at the bottom of the hour. I do know that there are lots of questions, so I will pause here. I'll let Nicole ask the first questions and those that have come in over the chat. But if you want more information, on the screen is how to find more about the project, follow our Twitter feed, and or send me a note. But with that, I'll turn it over to Nicole and the questions.
Great. Thank you so much, Brian, for that presentation. For the audience, please do continue to type your questions into the chat box in the control panel, and we'll get to as many as we can. Just to kick us off, we have a few different questions about how you arrived at the 5 dimensions and these different aspects of the project. Could you talk more about how the project and specifically the impact matrix were developed and who was involved in that development and consensus building?
Yeah. So the project really began in the fall of 2016, summer of 2016, and the initial process with funding from the Omidyar Network and Ford and DFID was really to convene an open set of what we ended up calling huddles among leading practitioners. My colleague Clara Barbie and I had both worked at a fund called Acumen Fund, which has a strong commitment to measuring and managing impact in an emerging markets context. And so the Acumen Fund team and a number of emerging markets fund managers who have a strong reputation for measuring and reporting on impact, including Leapfrog and Root Capital, among others, were all invited in to kind of try to figure out whether or not there was a consensus in how we approached this question. And really the exam question we've been given is there a common approach to that would also allow for a better understanding of the shorthand being impact asset classes, and we pushed back on the notion that it was impact asset classes, that impact is really a strategy within any asset class as opposed to an asset class itself. But through the conversations, we recognized that the what and the who and the how much were pretty standard among the practitioners, and these huddles were sort of a couple times a month, 90-minute calls where we would tackle particular dimensions of practice with lots of asset owners, asset managers, and fund managers, and some enterprises participating in this question of how do we measure and report on impact, how do we manage it. And so the derivation of the 5 dimensions really came early in the process. We then had a number of investors saying it's, the investor contribution matters. Again, voices like Charlie Kleisner's were influential. And the investors' impact matrix really emerged as the team tried to distill out the difference between the difference that an enterprise makes and the difference that an investor makes. And in testing with the PGGMs and UBSs and BlackRocks of the world, it began to take shape through their feedback. But the 1,000 or so folks who participated, there were probably 20% that were super active participants in a series of both online and in-person conversations, some of which were obvious, like the what, the who, how much. We arrived at pretty quickly. Some of which were quite contentious, like whether or not we needed to use additionality versus contribution. Those are sort of inside baseball discussions, but it's been again a field effort that we facilitated, but with contributions from a number of the leading practitioners, and this we do think reflects consensus in the impact investing space.
Great. And in addition to developing the framework, how do you see continuing collaboration with other organizations that you mentioned, like Gin Tonic, SASB, GRI, as the impact management project evolves?
Yeah, so we've got another effectively 6 months of work, and we've just issued a request for collaboration where we expect to work with some combination of those organizations, many of which who we've been doing this project with from inception. And the big question is, we think we've arrived at a conceptual way for how enterprises and fund managers should think about reporting and managing their impact. And if it can be done consistently, then it might inform how asset managers and asset owners allocate to impact. Moving from the conceptual to the implementation is a huge challenge. And one of the open questions is, what is the right leverage point to drive the adoption of this thinking? So for example, in all the impact funds that I'm familiar with, there usually is somebody who's responsible for doing the impact due diligence, collecting the data and reporting it. Those folks are typically self-taught, high integrity, high ambitious folks, but they're not certified public accountants like the folks who keep our financial statements are. And so is there an opportunity to take a page from the U.S. Green Building Council or the U.S. the Green Building Standards playbook and see if we can either rate funds and or rate the folks who do the analysis? And we've been having conversations with the CFA and the Chartered Alternative Investment Analyst networks to see if there are ways to do either professional education, executive education, or credentialing. We're also looking at the data conversations and how does the data actually flow. So we're having conversations with BLAB. So it's an open question. Our hope is that we can have a practical set of tools that asset owners and asset managers find accessible and a helpful way to address their impact goals. And the threshold test for us will be whether or not people understand and adopt this material based on webinars like this and or other fora where people who are wrestling with these issues can take and begin to adapt the frameworks to their own contexts.
And has this system been well received by the impact investing community so far? Do you have a sense of how many investors have tried it and a system for feedback?
Yeah, so we did, one of the things we got sort of funded in the most recent stage was a kind of a ongoing executive education session with the GIN, the Global Impact Investment Network's Investors Council, which is 60 or so of the leading impact investors. And we walked them through, we asked each of them to take an investment, whether that was a company or a fund, and try and walk through the ABC framework and understand the 5 dimensions of impact for an investment, as well as where they would plot themselves or a fund that they'd invested in on the investor's impact matrix. And that was hugely instructive. It was largely validating that we have a way of helping understand and create shared dialogue around impact, but we've gotten good feedback. So the uptake has been positive and enthusiastic, but I would concede somewhat limited to still a small group of folks who've been involved with the co-creation of the material. But the challenge now is broadly to scale it. Okay.
So if there was an endowment or foundation in the audience that was interested in mapping their portfolio to IMP's framework, is there any support that could be offered to help with that process?
Yeah, so the PGGM map happened with a lot of our kind of handholding and support, and we were able to tweak and improve the framework on the basis of the feedback. And we're still very much in the kind of 80% beta test stage. So if there were an endowment that we're quite interested, has already made a handful of either sustainable or impact investments, or has a portfolio of SRI funds and would love to think about how to organize it that way, we'd be happy to have the follow-on conversation. We've got kind of 6 months to help a handful of folks. The compensation we would seek is the willingness and ability to create a case study out of it, like the PGGM case or the K-alpha-Felicitas case. So in exchange for our time, we're sort of trading our time for having a profile of an endowment that would like to say, yeah, we think this is a helpful way of thinking about it, is candidly, it's a type of asset owner we have been less involved with than, say, pension funds and the private wealth and foundation communities. So yes, there's limited, and what we're trying to figure out is how do we, was just on a call with PwC, which is helping a large private equity firm adopt the framework for their new impact fund. And so one of the questions, we as a small team on this project are never going to have the resources to help even the 30 or so folks on this call. But how do we enable other advisors to understand the material and then provide the guidance that's necessary to use it properly?
Great. And we have a few different questions specifically surrounding the Sustainable Development Goals. I know you mentioned educational achievement. Yep. Could you talk more about how the impact management framework interfaces with the SDGs?
Yeah, that's a great question, and it's actually a miss that in this presentation I didn't make that more explicit. If you go, you don't need to go back up to the slides, but mentally, if we scroll back up to the 5 dimensions, the SDGs are really a very well understood now and increasingly embraced version of the what. And so the kind of high level 17 goals, or more appropriately the 160 some sub goals, really most of the impact investors and a lot of the organizations like the GIN and the Global Reporting Initiative are now mapping to those broad goals and the sub goals. And so from our perspective, the SDGs really are a very well understood, increasingly well understood version of the what. You know, other versions of the what include the IRIS indicators that the GIN has, the GRI and the SASB taxonomies. And what we're trying to do as a field, and I know that the GIN and the GRI, and we have been collaborating on a project to do this, is to make sure that people don't view them as competing entry points, but rather as complementary entry points. And so that the SDGs are mapped to IRIS, which is mapped to GRI, which is, you know, cross-references SASB, because we're all effectively addressing the same question of what impact do we want to see, using slightly different taxonomies or language. But there's a consensus that the interoperability of those frameworks is obvious to those of us who are, you know, in the weeds, and that making it clear to folks in a time-scarce world that they are interoperable, that it's not either the SDGs or the impact management project, but they're kind of both and, is really critical, because doing one without the other doesn't necessarily make sense, and they really are additive to one another.
And going off of the in the weeds comment, could you talk a bit about the challenges of working with the data available from public companies and making the management of impact possible? And then going off of that as well, how you net the positive impacts and negative impacts of companies?
That's a great question. And we have spent more time, obviously, as a private equity investor and at Acumen Fund, which was kind of a venture capital investor, with much more emphasis and focus on how does a small business from its inception, for which there is a high degree of control as an investor, defines and measures the positive and negative effects. And so a lot of the thinking really is derived from that context. As you go into the public reporting, you know, the work that GRI and SASB has done is really both path-breaking and really what we want to try and double down on. Whether or not people will actually disclose, you know, their negative effects or not is something that is probably beyond the scope of this project. There are a couple of partners in this project, notably the FB Heron Foundation, which has tried to develop a way of using existing data sources like MSCI, Sustainalytics. Arabesque is now entering the marketplace to understand whether there is a way to develop a net contribution. Businesses have positive and negative effects, and is there a way to kind of calibrate a net contribution? Now, that's a step beyond what we think we can actually achieve through this project, but that ultimately the question is, what level of transparency, honesty is there through the information that companies publicly share? What information can one glean from social media and and other sources, public data sources, private data sources, to create a complete picture of that footprint. But I do think that public company managers are now increasingly aware of the footprint that they have and are doing, often outside of a kind of public disclosure, what they can to improve their footprint, or at least avoid harm. Obviously, there still will always be public companies that are trying to exploit kind of commercially whatever they can. But for those that are seeking to at least avoid harm or benefit stakeholders, we know that there's a lot of work that's going in to how they embed that into their own internal management systems. That information is often never shared publicly because there's really little guidance on how it should be. So a great question. Again, a lot of the company level information is very much still small and growing private. And I think it's an open question as how we get the large corporates to disclose meaningful information to make that assessment.
Great. And moving more towards the actionable opportunity side of things, could you talk about how impact investing fits into other conversations that may be taking place on college campuses, including fossil fuel divestment, the Me Too movement, and ESG integration across the portfolio?
Yeah, and so I think there are obviously related conversations. I mean, I think the open conversation we've had about endowments is the governance by which current student, former student, staff, faculty preferences translate into investment decisions is not one that we have a particularly strong opinion on. What is normative and should happen versus descriptive as to what is happening. But obviously, if an endowment wanted to understand those preferences and give weight to them, and you were to take out the investor's impact matrix, you know, a divestment, a climate divestment decision would be about avoiding harm by screening out fossil fuels in all of your asset classes. A Me Too, conversation from my perspective would be about a gender lens investment that would seek to benefit women employees, women management, women boards, women customers, and to positively select businesses and/or funds that are particularly attuned to that as a criteria. And there's competing evidence, but one of the funds that's been part of this generation investment management uses a range of ESG integration screens to select public equity, and they've outperformed. I think there's still debate as to what extent does either responsible or sustainable investing lead to outperformance, underperformance, and I'm not going to try and opine on that, but certainly if that were an important goal and intention of the asset owner, you could use that lens to select businesses that are either benefiting or perhaps even contributing with products that have access to finance for women borrowers in a microfinance context, or lending to women entrepreneurs. And so from our perspective, impact investing is really part of that continuum. It's not quite clear that impact investing has grown up to a place where fiduciary investors can allocate comfortably to impact investment funds, which are typically mostly still private equity or venture funds. In emerging markets, the Emerging Markets Private Equity Association, has a strong bias towards impact. Not all of MPACT funds would call themselves impact funds. There's a comparable network growing up in the U.S., Impact Capital Managers, which are all high impact, high return U.S. funds, some of which have attracted traditional institutional capital. So I would view it as just part of that conversation. And most of what I've observed is that the confusion of how do you think about those things has made it hard for CIOs and trustees to understand where they fit together. And our objective, and again, the exam question we hope that we answered when Omidyar and Ford approached us via the Investor's Impact Matrix, is to understand how those pieces would fit into the kind of columns and rows, and what then products you might be able to achieve if you do decide that those are in fact investment goals that you want to pursue.
So this is going to be our last question. But building off of that and considering the continuum, what would you say is the best entry point for endowments, considering the four different ways you outline investors can make a contribution? In other words, what would your main call to action be for this audience?
Yeah, I mean, I would implicitly assume that anyone who has joined the Intentional Endowments Network is somehow signaling, or some subset of trustees and or staff is signaling that impact matters. And I think that understanding what the portfolio has in it that relates back to what you are signaling that matters is the first step. And so figuring out whether or not it is, gender equity, educational opportunity, local community engagement, environmental protection, they're all worthy goals, and figuring out what you think your capital can likely achieve through a diversified fiduciary portfolio is the most important thing. So understanding why you signal that impact matters and what impact goals you might have, my guess is probably ranges from the implicit to a handful of folks who've got explicit investment policy statements that take this into consideration. And so I would continue to focus on the rationale for why, and if you feel like there's a strong why, then understanding the how you're achieving it with your existing holdings by doing the kind of mapping that a PGGM or a KL Felicitas have done would be the first two steps. And if there is somebody who's there and feels conviction that they've got the why and is eager to understand the how and whether or not their portfolio is there, that would be a great case study that might be illustrative to your peers among the rest of the IEN network that we'd be happy to engage in.
Fantastic. Well, thank you again, Brian, for the great presentation and discussion. And also thank you to all of our participants for joining us this afternoon. If you have any questions about this webinar, the Impact Management Project, or activities happening in the Intentional Endowments Network, please do be in touch. Our contact information is on this slide. And again, this webinar will be up on our website shortly. So thank you again and have a great afternoon.
Thanks, Nicole.